The market has had some of its most volatile days of the year just recently. Is that a sign of more to come? I've got some perspective to help you make wise investment decisions. I've got that and more coming up. A wise man once said, this is how the stock market works. It advances to reach all-time highs, and then it retreats off of those all-time highs, and then it recovers and goes on to make new all-time highs. And if you think about it, I don't know. Your reaction is going to be your reaction. I get irritated. That phrase frustrates me because in the moment, it doesn't feel like that. In any direction, you just assume, well, things will just continue in that same direction because why wouldn't it, right? And there's, so there's greed and then there's fear, but also that oversimplifies, well, when? When is it going to retreat from those highs? And how long will it, fall? And then when will it recover? And that's, it's very, very simple. And yet at the same time, that's why it's a wise saying and so profound we don't know anything about the future. We can tell based on just, decades of history, that is how the market moves. And so right now, recently, at the time I'm recording this, we've had some of our most volatile times of the year. It's very common for the stock market to have a lot of ups and downs, even in an advancing trend, where it will fall more than 1% during the day or intraday, more than 2%, more than 3%, even in a day. And all of that can occur even though things are generally trending higher. And so the question right now, as we're sort of in the midst of a bout of volatility, is there going to be, is this one of those, retreats from those all-time highs sorts of scenarios? Or is this just one of those, couple of blips, profit taking, if you will, on the way to kind of pushing higher? What's been causing the jitters? Of course, inflation concerns with rising oil prices, gas prices, and so on. Right. So that certainly has created. Well, what's the Fed going to do? And you don't want to fight the Fed. That's another market saying, and so that's created some concerns. Yeah, the ongoing Iran war. Do we have a deal? Do we not have a deal? Is there a ceasefire? Is there not? Like, there's a lot of just frustration, obviously, over that, and angst on the market. And then, of course, AI. And we've talked about this before, if you're a daily watcher of the Wise Money Show, that, well, is AI a really good thing? Is it a bad thing? Wall Street's unsure. I think predominantly it views AI as, no, this is going to bring great productivity and a lot of scale to the economy. This is going to be good. But then there are moments where it's like, oh no, we don't, this is concerning. And so there's sort of been all of that has been baked into the volatility. In addition to that, not a headline, but it certainly, Bank of America didn't miss an opportunity to call a top here just recently, just a few days ago or so. Bank of America said, listen, it's time to start protecting. There is a warning sign being raised by their 10 factors that they say help indicate whether we're going to see a bear market or not. Now, a bear market, different than a recession. Typically, they go together, not all the time. A bear market is a drop of 20% or more in the stock market from a high. It doesn't even need to be an all-time high, but from a high point, from an advancing stock market, a decline of 20% or more, that's a bear market. Oftentimes deals with or coincides with a recession, which, just at a surface level is 2 consecutive quarters of negative GDP. But then the eggheads in a certain group need to officially declare we're in a recession. We've had times when we've had 2 consecutive quarters of negative GDP, and the think tank said not a recession. And so, so it's more complicated than that. But a bear market, this is what Bank of America says, because no one can tell, well, when are we going to retreat from those all-time highs and how bad is it going to get? No one knows. Bank of America, though, has a framework, 10 different factors. And they're saying 7 out of the 10 are now flashing a warning sign. And they're saying, be prepared. So if you take a look at the grid here, it's broken down in different categories. So overall sentiment, so how do people feel? Valuations, yes, that absolutely matters. Ultimately, it all does, on the day-to-day and the moment-to-moment, the market moves by speculation, fear, and greed. And yet over time, it moves based on earnings. So are companies growing their profitability? And so valuations absolutely matters, and then macroeconomic issues. And so the ones on this list of the 10, the ones that are triggered, stock price expectations indicator, yep, that's triggered. They're saying long-term growth expectations, number of merger and acquisition deals, yep, that's been triggered. Price to earnings and plus the CPI, yeah, that's triggered. Cheap versus expensive stocks, they're saying expensive stocks. And then two of the macro indicators, credit stress indicator, which that's concerning, that is flashing a warning sign. And then tightening lending standards meaning banks or lenders are getting more restrictive on who they'll lend capital to. Obviously, the more they lend out, the more activity that can be generated in the economy. And so if they're tightening that, that's going to lead to less liquidity, potentially less economic expansion. That's their view. No one knows. Only time will tell. It'd be interesting to tune back into this to say, well, did those warning signs fade away? Did the light go from yellow to green in this example? Or did it go from yellow to red? Interesting, we'll be able to look back and see. However, as of right now, and no one knows, but as of right now, the current amount of volatility that we've seen, I would classify as normal. Even though, yes, valuations are stretched, and I've been sharing, yeah, it is important. Every investor needs to make that ultimate call of how much offense and how much defense you should be playing. More on that in a second. It is very normal for the stock market to have a lot of swings throughout the year. One of my favorite data points is this chart right here, showing in the gray bars, that's where your eyes will be drawn to, that is the annual return for that calendar year of the S&P 500, the stock market. Not a diversified portfolio. That'd be an even more interesting chart, by the way. So JP Morgan, go out and make that. But this is just the S&P 500 showing the ending return for that calendar year on the bar charts. And you can see 35 out of 46 years have been positive. I'll take that, right? I will take that. And there's no way of knowing which ones will be positive or negative. So I'm just going to take those odds. That's pretty good. However, what are the red dots and the red numbers? That is the from a high point to a low point. How much was the stock market down at one point during the year? So not that, from January 1 to a certain point, what was it down, but just from a random high point. Very, very frequently, the stock market will advance to start the year and then come back and retreat off of that advancement. And that's what the red number is showing. So this year, -9. Okay, that you might say, when did that happen? Did that occur? Yeah, it actually did, but it would snap back very, very quickly. Last year, 2025, a 19% decline, almost a bear market. You might say, no, it didn't. When was the tariff tantrum, right? That was that. It was just a couple weeks. That was one of the sharpest drops and then subsequent sharp rebounds during that time as well. But 8%, 10%, 25%, you have to go back quite a ways, right? 2022 for it to feel like, oh yeah, that was a big decline. Guys, the average peak high point to a trough low point during the year, intra-year, 14%, 14.2. Guys, we haven't had average yet. And so, yeah, I would expect jitters, and there is a lot of uncertainty. No way of knowing whether this leads ultimately to a bear market or not. So what do you do? Number one, you have got to make sure, especially at a time if we start seeing some volatility or some risk off, I don't like this, let me, flee to safety. You've got to make sure that your investment strategies, your investment approach is connected to your goals and objectives of your financial plan. That is geek speak or professional speak for saying, make sure that you are investing appropriately for what you need the money to do for you. Therefore, if you are very, very close to retirement, it doesn't make sense to be swinging for the fences. If you are very, very young, you need to look at this volatility and shear the market down, as weird as that is, because you are in buying mode. You need to make sure that your investment risk, your strategies are appropriate for the goals that you're trying to achieve within your financial plan. That's why you're investing. No one likes the volatility in one direction. We like it on the way up. You can't get the way up without getting it being exposed to the way down. So make sure that your investment approach connected to your financial plan. That's number one. Number two, as a long-term investor, make sure you're diversified, right? Make sure you're diversified. Are you going to like diversification? You won't, because you're constantly just going to play the compare game, and there's always going to be some of your investments that are outperforming others. That is why you have diversification. But we are at levels, valuation levels, where previously, not every time, but previously the S&P 500 went on to not have a positive return over a 10-year time period. That's not our expectation right now, but part of the Bank of America analysis and just looking at history, there have been a lot of times when stocks are this expensive where over 5 years, there's not a lot of real return. Not saying that's going to happen right now, but make sure you're diversified beyond just large cap stocks, beyond just the stock market. Be diversified. That's second. And then third, don't just diversify your asset categories, or they're called asset classes. Large cap stocks, mid cap stocks, small cap stocks. Don't just diversify the funds you hold. So many people hold 3 different funds that are overlapped. Do the same thing. The third thing is you need to make sure you're diversifying your strategies, because is it possible, if the stock market does go risk off, nope, we're afraid of everything right now, the sky is falling, that both large cap and mid cap and small cap stocks can all go down together? Yep. What about international stocks? Yep. What about emerging markets? Yep. What about gold? Yep. What about bonds? Yep. And I'm not sensationalizing. There are times when you really need diversification to show up and it doesn't show up. So make sure you've got multiple investment strategies that actually provide true diversification and an offset correlation. Sorry for the jargon there. Work with your certified financial planner on that to make sure that you've got the right wise investment approach to meet your financial goals, despite whether we see this is just normal volatility or this becomes a serious pullback. If you don't have a CFP on your team, contact one on my team. You can find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.